Welcome to Delphos Insights. Our mission today is to take a strategic overview of the global financial landscape, and we're pulling our insights straight from the Global Capital Transformation, Emerging Markets Investment Outlook 2026. We've got a stack of sources here detailing some seismic shifts underway, and our job is to synthesize what matters most for you, whether you're an investor, a policymaker, or just intensely curious.
And the core thesis of this material really sets the tone for everything we're going to talk about. It argues that we're not just in a gradual financial transition.
Right. The word they use is transformation, and that's a much heavier word. It suggests deep structural shifts that won't just, snap back to the way things were.
Exactly. I mean, when you look at the drivers, this convergence of multipolar economic forces, shifting geopolitics, the huge capital demands of AI, and the absolute imperative of climate adaptation, these aren't temporary cycles.
So it's not something a good interest rate cut is going to solve.
Not at all. These are permanent gravity shifts for capital. If you don't adjust your strategy to these new forces, you really do risk being left behind.
And what does success look like for investors trying to navigate this in 2026? The outlook seems to say the rewards will go to those who can combine two things: resilience and creativity.
That blend is absolutely critical. Resilience in your asset choices and creativity in how you structure the financing.
Okay, let's start with the big picture then. Unpack the macroeconomic reality that sort of defines the starting line for 2026.
Well, the sources all suggest the global economy is settling into what you have to call a new low-growth reality. Global GDP growth is expected to ease to about 3.1% in 2026.
And that's not just a cyclical slowdown.
No, it's structural. It's being forced by slower productivity growth in developed markets and, frankly, just increasing friction in global trade.
That 3.1% figure is definitely softer than what we've been used to, so that forces a more selective approach for capital. But the report is clear that emerging markets, or EMs, are still the primary engine of expansion.
They absolutely are. And the mechanism driving that EM growth is shifting. It's becoming more internally focused.
So less reliant on exports.
Exactly. It's increasingly driven by domestic demand, by fiscal stimulus supporting household consumption and local investment. And that suggests a real deepening of local capital markets in these key economies.
That's a huge positive story, but we can't talk about global finance without talking about debt. That persistent challenge of global debt.
It's the constraint that acts as a ceiling on everything. The sources estimate total global debt is over 235% of world GDP.
235%.
It's a staggering number. And it constrains fiscal policy everywhere. Governments just have less room to maneuver. And it directly influences how sovereign risk is perceived.
With a figure that high, doesn't that risk just overshadow the potential in emerging markets? I mean, where's the silver lining here?
The challenge is acute, but the silver lining is necessity. It forces innovation. For developing countries, the report highlights a U.S. $741 billion financing gap just between 2022 and 2024.
So public finances just can't handle it alone.
Not even close.
Yeah.
That massive gap means public capital has reached its limit. And that's why the report stresses over and over that private capital and innovative financing structures are now crucial. They're not optional anymore.
It's the only way to close a gap of that size.
And we also have to acknowledge the external factors, especially the central banks. Their interest rate decisions shape everything. But you have to pay close attention to the U.S. dollar.
Its strength is still a major headwind for EMs.
A significant one. It directly influences their debt burdens. A stronger dollar makes those dollar-denominated repayments more expensive in local currency, and that increases default risk even if the underlying economy is perfectly healthy.
Okay, that sets a very complex stage. Let's move to the three major structural forces that are redefining how capital moves. Force number one, the multipolar world. This is more than just geopolitics, it's financial fragmentation.
And this shift is changing the where and the why of investment. There's a fascinating data point here. Overall foreign direct investment, FDI, it rose 4% in 2024.
Which sounds robust.
But there's a catch.
There is. When you dig into it, the underlying productive FDI, the money going into building new things, actually fell by 11%.
So more money is crossing borders, but its purpose is changing. Can you just quickly explain the difference between overall and productive FDI for our listeners?
Of course. Overall FDI includes things like mergers and acquisitions, financial transactions that don't necessarily create new factories or jobs. Productive FDI is investment in new capacity, a manufacturing plant, a logistics hub, a data center.
So that decline in productive FDI means capital is shifting toward regional resilience, toward security of supply, Things like friendshoring? Precisely. It's moving away from purely cost-driven globalized efficiency. It's a defensive regional move, not an offensive global one.
And that leads us right into force number 2, which is creating its own massive demand. The surge in AI and the physical infrastructure it needs, this is a very debt-heavy capital cycle.
This is maybe the biggest driver of new capital deployment right now. Data center capital spending is projected to grow at an incredible rate, 40% annualized through 2030.
40%.
Yes, potentially reaching a total of $4 trillion US dollars. The demand for processing power and therefore physical space and energy is just insatiable.
4 trillion is a huge number, but the report says it's a debt-heavy cycle. What are the risks of funding that growth with debt?
The risk is in the leverage. Companies are relying on corporate bonds, private credit, project finance, and this is going to shape balance sheets for years. If interest rates stay high or inflation is stickier than we think, the cost of servicing that massive debt load could become a major problem.
It's that convergence. The digital need for AI meeting the physical need for energy and buildings and creating leverage. The report synthesized this perfectly.
Yes, the researchers put it perfectly, and it's worth repeating. The convergence of AI, energy, and infrastructure marks one of the largest capital cycles of our era.
Which brings us to the third force, adaptation finance. We've heard about climate finance for years, but the focus seems to be shifting.
It's a real evolution. Climate finance flows are already over $2 trillion a year. But the focus is moving from mitigation like building a new solar farm to reduce future emissions to resilience and adaptation.
Meaning investing in assets that can withstand the climate impacts that are already here.
Exactly. Severe weather, rising seas, extreme heat. This opens up entirely new asset classes and requires updated risk assessment, especially for infrastructure, agriculture, and real assets.
So an asset's ability to survive a 100-year storm is becoming a measurable financial metric.
It's transitioning from an environmental concern to a critical financial one. It offers a fundamentally different risk profile.
Okay, so the game has moved from mitigating the future to adapting to the present. How does that play out in the top 5 investment trends for emerging markets in 2026? Let's start with trend 1, which flows right from that last point. The rise of adaptation as an investable asset class.
This is where the rubber meets the road. We're seeing major private capital flowing into projects focused on resilient infrastructure, water management, and climate-smart agriculture. These are commercially viable assets.
And the value proposition is stability in a volatile world. The data in the sources on the infrastructure gap makes it clear. The need rises to 4.6 trillion by 2040, but current trends only meet about 3.8 trillion.
So closing that gap with resilient assets, especially in vulnerable EMs, offers those stable long-term returns investors are looking for.
Which brings us to trend 2, blended finance beyond aid. With public finances so stretched, traditional aid just can't cover the scale of what's needed.
So this is about using public or philanthropic funds strategically to de-risk investments, to make them palatable for huge institutional and private investors.
How does that de-risking actually work in practice?
It could be by taking the first loss piece of a deal or providing guarantees against political or currency risk, the things the private capital hates. This small bit of catalytic public money transforms the risk-adjusted return, and suddenly a project is viable for a pension fund.
Trend 3 is about data-driven ESG integrity. It seems we're moving past vague greenwashing commitments.
We are. Investors now demand measurable impact and credible data, and the market is starting to reward that. There's a great data point showing that green bond issuers reduce their emissions intensity by an average of 21% 1 year after issuance.
21%. That shows genuine transformation is being rewarded over superficial claims.
It's accountability translated directly into financial performance.
Okay, trend 4, energy storage and transition financing. We know clean energy investment is huge. It's expected to attract something like 2.2 trillion of the 3.3 trillion in energy investment in 2025.
But the real bottleneck, for both the grid and for supporting that AI boom, is storage. That is the critical investment opportunity now. Financing grid modernization and storage solutions is central to making renewables and AI work at scale.
And finally, trend 5, the expansion of private credit across frontier economies. This is where capital is finding its way around traditional banks.
The growth is explosive. Global private credit hit $1.5 trillion in assets in 2024, and is projected to hit $3.5 trillion by 2028.
Nearly doubling.
And it's crucial in emerging markets because it's a more flexible and efficient source of capital for mid-sized businesses and infrastructure projects that banks often can't or won't touch.
But if it hits 3.5 trillion, are regulators ready for that? Especially in frontier economies where oversight can be weaker.
That is a primary concern. The report notes that while it offers great returns and diversification, the regulatory framework is lagging. The challenge for 2026 is ensuring it's deployed with transparency to protect against systemic risk.
That gives us a great framework. Now, let's connect the dots with some of the specific regional case studies in the sources, starting with Africa.
Africa is a perfect illustration of blending finance and digital infrastructure. On the energy side, we saw a blended finance transaction advised on in 2025 to deploy 120 megawatts of mini-grids and battery storage.
A perfect example of Trend 2 in action. Blended capital, accelerating clean power access, and delivering real, measurable social impact.
Precisely. And the digital side is just as compelling. The sources mentioned raising capital a few years back for Kuba Kenya Ltd to advance their telecom infrastructure. And that's relevant now because that digital backbone, the fiber, the towers, is the absolute prerequisite for Africa to capitalize on the AI revolution.
Moving over to Asia, the focus is clearly on regional connectivity and supply chain innovation, which responds to that multipolar world force.
Right. Cross-border infrastructure is being prioritized to insulate regional economies. A great example is securing a $2 million grant for a feasibility study on transmission interconnectors between Indonesia and Malaysia. It strengthens energy efficiency and regional resilience.
And we're also seeing support for logistics technology platforms, enhancing digital warehousing, and AI-enabled transport. That aligns with optimizing these new regionalized supply chains.
And finally, Latin America. We see a clear focus on climate resilience and using private finance to address that credit gap. In Guatemala, for example, advising on $34 million in non-recourse project financing for a solar plant.
And non-recourse is key there. For our listeners, that means the debt risk is tied to the project's cash flow, not the developer's whole balance sheet. It's essential for getting these big projects off the ground.
It is. And that deal combines adaptation finance with smart structures to support sustainable agribusiness.
And that Chilean example validates the private credit trend. Structuring a facility for a fintech called Maxa to provide working capital for SMEs.
That directly addresses a credit shortage where traditional banks fall short. It's private credit going straight to the productive core of the economy.
These cases really show that capital is shifting toward assets that offer resilience and productivity. It's not just about chasing the highest return at any cost anymore.
So synthesizing everything, 2026 demands a radical shift to an active, strategic investment approach, one that targets these resilient, productive assets.
Absolutely. But outperformance also means managing the downside. The influence of the U.S. Federal Reserve and other central banks, especially with sticky inflation, it just can't be overstated.
Capital flows are acutely sensitive to that. And for investors looking for resilience, the outlook notes that value stocks can offer opportunity during periods of volatility. It's about balancing risk management with creative deployment into this new reality.
Considering the rise of multipolarity and the need for localized resilience, how will this transformation redefine the concept of global supply chains in the face of converging AI and climate risk? This has been Delphos Insights. Learn more at delphos.go.